My simple two-fund portfolio has outperformed the S&P 500 by a comfortable margin over the past 14 years. A bold statement like this should be a red flag for experienced investors. And you should be skeptical, because the S&P 500 consistently outperforms over 90% of the professional investors over long periods of time. But in this video, I'll provide the data that shows how my mix has crushed the market. We'll also look at a couple alternative builds that have outperformed over the decade and a half if you want less tech exposure. This isn't a flash in the pan strategy either. The downside protection has been as good or even better than the market. There will be no cheap past performance monsters lacking downside protection, like Bitcoin or SMH in this one. Sit back and relax, grab yourself a drink, and let's take on the S&P 500 together. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please hit that like button with a haymaker, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. Quick note before we dive in. I use Seeking Alpha and Snowball Analytics in my investing. And while they're not sponsors, I do think they're incredible tools. I've dropped links in the pinned comment if you want to try them for free and support the channel if you like what you see. You know what time it is. Let's grow. Beating the S&P 500. I know this section title probably makes you roll your eyes if you've been investing for a while. Trust me, I get it. Consistently beating the S&P 500 is one of the hardest things to do. And the real key is not just that it's difficult, but why it's difficult. I've read countless books on this topic, and I've gone deep, very deep, down this rabbit hole. When I said in the intro that there's a way to do it, I wasn't exaggerating. Most investors fall short of this legendary index, but that doesn't mean we have to. I think it's important to start by calling out a few common strategies that will not help you consistently beat the market. Handpicking stocks that you think are winners without putting in a ton of research, chasing hot market tips, stop reading the news and getting caught up in the hype, just read annual reports and actual facts and data. Single factor plays such as a focus on size, momentum, or value only. Winner chasing based on past performance. I feel like that's the most common one for newer investors. The usual gut feel and emotional madness. We've all been there. And the granddaddy of them all, market timing. Good luck hitting that button with perfect timing twice in a row. Instead of doing any of those lovely strategies, let's start by scoping out the competition. We'll talk about what the S&P 500 is, and I'll keep this one brief because most of you are familiar with the market. I've pulled up the Vanguard S&P 500 ETF, which is my favorite. It's a good low-cost, solid name behind it ETF, and that's ticker symbol VOO. But there are a plethora of S&P 500 ETFs and mutual funds. So find your favorite, one that you're comfortable with. Make sure it has a low expense ratio. You can see here that VOO has a 3 basis points expense ratio. So you get all the power of the market in your hands for a mere $3 for every 10,000 you have under management. It basically rounds to being free. And what the S&P 500 is it's an index that follows 500 of the largest companies in the US, and that actually makes up about 88% of the total market in the US. In other words, VOO is about 88% of VTI, which is the total US stock market. They have an 88% weighted overlap. And that's why people commonly refer to the S&P 500 as the market. And you can say the same thing about VTI. And you can see from a holdings breakdown, the S&P 500 right now is 35% technology, 13 financials, 11% consumer cyclical and 10% communication, 9% healthcare, 8% industrials, and then consumer defensive is 5% and energy rolls in at 3%. But the thing I love about the S&P 500 is that as companies come and go, some companies will fall out of favor, go bankrupt, they'll be removed from the index, and the new up-and-comers, Tesla and Microsoft and Apple, way back in the day at one point were little guys and then they bursted to the scenes, they'll automatically be added as they become one of the larger companies in the US. So without lifting a finger, you will always have the 500 largest companies in the country, and the sector balance may change, but it doesn't matter because you're getting in and out real time as the companies come and go. And you can see right now the top 10 holdings, I'm sure, unless you live under a rock, NVIDIA has gone ham the last year or so. It's up to 8%. So not too much of a weighting compared to some of the growth ETFs. And then you have your Microsoft, Apple, Amazon, Meta, Broadcom, Google, Berkshire, Tesla. Again, unless you're waking up from a coma, you've heard of each and every one of these companies, and that's the beauty though. If one of these go poof, it's okay. It's out of the index and in comes the new ones and the weight fills itself up. So you really can't mistime the market if you simply hold the market. And you can see here it has 500 companies, and the top 10 only make up 38%, which is very low compared to its growth counterparts. I jumped over to Morningstar and I pulled up VOO again, and you can see here on this chart of style that if you're over on the left, you're a value company, and you can see large, mid, and small. So the S&P 500 is pure large companies. That's its thing. But from a growth here on the right and value perspective, it's smack dab in the middle, a little closer to value compared to its peers, but this is what we're going to try to replicate. SCHD gets us over here. We need to find the best friends that are somewhere over here. When you add them together with the 50-50 mix, you'll have a PE ratio that's nearly identical to VOO. The S&P 500 secret sauce is its built-in balance between growth and value. And that's exactly what we're going to upgrade in this video. But before we move forward, we need to clear up a common objection regarding the balance. Growth has been on a historic run the past couple decades, but zooming out over the past century, value has come out ahead. As far as the future, nobody knows. Growth may keep on soaring, or we may string together more years, like 2022. That's why we stick with an equal growth value mix. It keeps us trending with the market while giving us a chance to improve the quality on both sides. Enough theory, let's build. Why SCHD for value? SCHD has taken a lot of heat in the past few years when it comes to total returns. Plenty of dividend-focused peers have outpaced it recently, but if we step back and look long-term, SCHD's track record is rock solid. And while everyone loves to say that past performance doesn't guarantee future results, what really sets SCHD apart is its methodology. Unlike many peers that only screen for dividend growth, SCHD puts a lot of weight on the strength of company balance sheets. The result is focused on a list of 100 high-quality blue-chip stocks. I won't rehash every detail here since I've covered SCHD so often on this channel. But if you want to dig deeper into the specifics, just look up the Dow Jones US Dividend 100 Index, which is what SCHD tracks. Let's pop out to Seeking Alpha to see what this one has going on. I've pulled up the one and only SCHD out here on Seeking Alpha. And the first thing I'd like to note is this juicy, wait, that's a bad word to use, this anemic expense ratio of 6 basis points here. So you get all this goodness we're about to talk about for $6 for every 10,000 that you have under management. Not too shabby. And speaking of the assets under management, it has over $70 billion worth. So this thing is as liquid as they come. Now on the holdings breakdown, one thing I love about SCHD is you see technology is way down here at 10%. And you might say, but Teeps, you're a tech bull. Have you had one too many today? And the answer is no. It's just holding VGT and VOO and other things that are fairly high in tech, this gives a nice counterbalance. And we'll get more into that here in a bit. But you can see that nothing exceeds 20%. And the hard cap's actually 25. So they will sector hard cap, but it looks like they don't need to right now. Consumer defensive is right there at 19.5, energy at 19, you have healthcare at 16, technology, consumer cyclical, and industrials all in there at 10%, and then financials is there at 9. So you really do have a good balance with 7 different sectors being 9% or higher. I love that coverage. And then communications comes in at 4.5. And for the top 10 holdings, I won't read off all these names. You can see it's a lot of household names here, stuff that you would recognize, all dividend payers. And the rule on the holdings is that they won't exceed 4%. Now you're saying, well, are you blind? These are over 4. But what they do is a quarterly rebalance to get everything back down to 4 or lower so you don't have any runaways. And then once a year, it adds and drops companies with the reconstitution. And the top 10 names are 41.5%, not too bad compared to a lot of ETFs. And you can see here that it has about 100 companies that it holds. Okay, we popped over the dividends tab. Now this is where I could talk all day, so I'm gonna make this quick. You guys just see me talk about this one a million times if you followed the channel. But one thing I love about SCHD is that it consistently grows its dividends. Now again, not dividend yield, because as the price goes up and the dividend itself, the nominal amount grows, the dividend yield can actually go down if the price outpaces the growth of the dividend. But this dividend growth rate is what you compare to inflation. This is how much the thing actually grew as a dollar amount over a dollar amount. So the trailing 12 months, it's grown at 8.5%. That crushes inflation. The 3-year CAGR, which is the annualized growth rate, 8%. And then the 5-year CAGR is a sweet 11%. And that 10-year CAGR is nearly a juicy 11% as well. Just think about that conceptually. If you got a raise of 11% a year, or think how bad on the inverse side 11% inflation would be, you basically have your dividends inflating, I say that in quotes, at 11% per year. That's absurd. And this thing's been around for 13 years. Guess how many years in a row that it's grown its dividends? You got it. It's never paid less dividends than it did the year before. Not once in its history. We're on a 13-year streak. And it comes at a starting fairly juicy compared to a lot of the competitions, 3.75% dividends. Okay, and I had to pop out to the charting tab real quick. And we don't really chart. This is a floor protector, not a total machine monster. But man, everyone keeps saying how much of a dud SCHD is, so I have to show this every year in this series. SCHD's inception was 10/17/2011. At least that's when it started getting data. And I have this for its first 4,088 days, all the way through 2022. Its total return, including dividends, outperformed the market by a decent margin. The only reason I show this is because please don't get swept away by the haters saying it's a terrible investment, it doesn't grow, the price has been horrible, because they're right, it has for 3 years. But as we look at 11 years versus 3 years, we have a total of 14. I think I'm going to put some weight into the 11 years. And by the way, spoiler alert, the underlying index has actually outperformed the S&P 500 since 2000, which is its inception date. I just like to throw this out here because we get caught up in the growth carrying and the value, specifically SCHD, just being absolute duds. And then a lot of people complain that the floor protection isn't good enough and blah, blah, blah. But guess what? Over the last 100 years, this has actually been the trend. You can look that up. Value has outperformed growth. So let's not get too tunnel visioned here. That's all I'm saying. SCHD isn't just a token throw-in. For me, SCHD remains the clear choice on the value side. And nothing else has come close over the years. Its worst calendar year of total return was only around negative 5.5%, which shows just how powerful it is as a stabilizer in rough markets. And one of the best parts is that SCHD has very little weighted overlap with the growth ETFs that we're about to get into. Best growth ETFs. There are plenty of quality growth ETFs out there, but only a few pair the best with SCHD to give us that consistent outperformance. For this video, I'm narrowing it down to 3 that I would personally put money into, the ones that I think are the strongest all-around choices. My top 3 are VGT, QQQM, and SCHG. But before we dive in, we gotta give kudos to SCHD once again. Let's quickly check out how well it pairs with these growth ETFs compared to its dividend growth competition. I threw together this fund overlap by weight chart to compare our favorite growth ETFs to our favorite dividend friends. Now you can see here that SCHD, and if it's under 10, it's green. It only has a 3% weighted overlap with VGT, a 5% weighted overlap with QQQM, and a 0% overlap with SCHG. That's impressive. Now with DGRO, you mix in a lot more tech and growth. With VGT, it's at 18%. With QQQM, it's over 20%, and that's why it's red, at 22% overlap. And SCHG has an 18% overlap with DGRO. And now VIG is even worse, and a lot of people know VIG has a lot of tech and growth. You can see a 25% overlap with VGT, a 30% overlap with QQQM, and a 27% overlap with SCHG. A quarter or higher across the board. That's not good. And then with VYM, it's a little more value-based, more akin to SCHD, but frankly, not as good across the board on total returns over long periods of time, dividend yield, and dividend growth that falls short on all 3 pretty consistently. But it still has a 12% overlap with VGT compared to the 3, a 17% with QQQM, wow, and only a 7, so that's pretty good. We'll give it that with SCHG, but SCHD has a 0% overlap there. And a lot of people that have been around my channel and in the comments, you probably realize by now that investors' lack of understanding of meaningful overlap is one of my biggest pet peeves in investing. Like people that think you can't combine QQQM and SCHG within the growth section with split dollars. Oh, don't even get me started there. But when you're talking across portfolio sections, you truly do want low overlap numbers because, for example, when VGT and QQQM and SCHG, these growth guys crash, you don't want a quarter or even a fifth of your value crashing proportionally with the growth. You want a counterbalance, a holding where the value goes up. So SCHD truly shines as a counterbalance to these behemoths, and that overlap actually does matter. VGT is my favorite of the group, and not just because of its past performance. It's been my go-to growth ETF for years, and for full transparency, my average cost is $246 per share. I'm a long-term tech bull. I believe in where it is today, but even more so in where it's heading tomorrow. And I don't think any of us can predict the next specific breakthrough. Is it AI, semiconductors, or something we can't even imagine right now? But I can be fairly confident that it will come from tech. And that's why I like VGT so much. It spreads across 300 plus companies from small and mid cap all the way up through the giants. Compare that to something like XLK, which has high overlap with VGT, but it only holds about 70 names and only the big players. SMH is another monster performer, but with only about 25 semiconductor holdings, I don't view any single tech subsector as a set it and forget it solution. And then we move on to QQQM and SCHG. And these bad boys are direct competitors. Probably more than most people even realize. This holdings breakdown spreadsheet will show you just how close these two really are. So SCHG and QQQM have nearly identical top 10 holdings. There's a couple that are flip-flopped if you look down the list here, and I won't read them all, but the names are more or less the exact same. But something to note, and this always seems to be the case, SCHG is always concentrated higher in its top holdings compared to QQQM. You can see Nvidia is 12% instead of about 10, and Microsoft 10.5 instead of 8.7, and on down the list. And that's something that's always there. So I feel QQQM has a little better balance within the top 10 holdings, but then it only has 100 holdings instead of around 230. So you really can kind of pick your poison as far as which one you think is more diversified and balanced. And you can see they have a 64% weighted overlap. So they're 64% identical as is, and their sector breakdown, they're both tech heavy. QQQM is a little higher in tech, but SCHG is right there at 50%. Consumer cyclical is similar, and then communication, same concept. Healthcare's there, and then financials isn't in QQQM, so it is 7% heavier in SCHG, and it makes up with it here in QQQM with a little more consumer defensive. But the top 10 holdings really are about the same. You can see the top 10 percentage is only 52 in QQQM, but it's 58 in SCHG. So I don't know. I feel this one might be a little more balanced, even though you get more names, but that it's debatable. But the point of showing this is just to show these are very similar. You could go with this one. You could go with this one. You could split dollars between the two. It really doesn't matter. They're both quality growth ETFs. These are my two favorite multi-sector tech ETFs. And I really don't think you could go wrong with either one of them. But the scorecard that matters most is total return. Let's see how these monsters stack up. Okay, and we're coming right out the charting tab because you know what? We're talking about our growth big boys and we're just going to skip over all this stuff. Cool, looks great. All right, we're here. And I do have this bad boy set for total returns you can see here. And I started out here on year to date. We're going to zoom in and then slowly zoom out. And I should note that I'm using QQQ instead of QQQM because it has all the history we're going to look at. But just know that the returns are very, very similar. This one just has 5 more basis points of an expense ratio. Now, year to date, speaking of that alternate, QQQ is up nearly 12% compared to VGT's 11 and SCHG's 9. So far, QQQ's taken that lead, but barely. Let's scooch it out one full year. VGT strikes back with a 21.5% return. SCHG is now second at 20.5%. The Qs fell down to about 19%. Everything pretty close still. And scooching it out 3 years, VGT takes a slight victory over SCHG, although you could argue it's much nicer at 84.69% to SCHG's 83.3%, and then QQQ bringing it up the caboose once again at 80%. Now moving out 5 years, wow, okay, upset alert. We have VGT at 133%, SCHG is at 118.5% to QQQ's 113%. And then the second biggest range, that's right, the second biggest zoom out, has VGT at a ridiculous 656%, outpacing second place QQQ's 490, and then SCHG begins to fall quite a bit behind at 406%. Okay, and as promised, I now have put in a custom range here for SCHG's inception date of 12/7/2009. So we're pulling as much data as possible, and we're looking way back here in the time machine. You can see they all pull the same amount of days, 5,732. VGT takes the lead at 1,452%, just eking out the Qs at 1,402%. And SCHG has fallen way behind by nearly 400%, clocking in at 1,014%. I like to just zoom this out as much as possible. I'll do this every year in this series because it's just good to see more data. Year to date, 1 year, 3 year, kind of like I talked about with SCHD. It's fun to see, but really we are investors. We buy, we hold, we chill. So the more, the merrier. It's time to see who really comes out on top in a real life situation. The winning mix. Here we are, the moment of truth. I've thrown a lot of ideas at you, but do these mixes deliver? Or am I basically just giving TED Talks to my dog at this point? We're about to find out with the 14-year backtest. Each of our combos will go head-to-head against the S&P 500. Okay, let's set the table for our scenario. We're out here on Portfolio Visualizer, which is my favorite tool for these, but again, it's very expensive. Trying to get affiliate link to potentially save you guys money, but have not been accepted yet. We have 3 portfolios we're looking at here. VGT plus SCHD, QQQ plus SCHD, and SCHG and SCHD. That's portfolio 1, 2, and 3. And then our benchmark portfolio 4 is VU, which is the competition. And you can see down here, they have a bunch of defaults, so I have to start a little lower. Here's portfolio 1 with the VGT, portfolio 2 with the QQQ, and portfolio 3 with the SCHG, and then they all have their 50% SCHD. And before we dive in, what am I doing here? Let's do the settings. So what we're pulling is, really it's going to be 2012 through 2025, include year to date, yes. I just left this default because I want to pull as much as possible, but I know with SCHD's inception date, it's going to be 2012 through 2025. But with year to date, that gets us almost 14 years of data, so I'm okay with that. Starting with $10,000 invested and contributing $1,000 per month. I always like to make it realistic because we'll be pumping money into these things over the years in our accumulation phase. And then rebalancing annually. Reinvest dividends, of course. Display income, yes. I think that's good. Let's just hit analyze here. And you can see here we're from January 1st, 2012 through 8/18/2025, nearly 14 years. And let's just scroll right to the juicy stuff. So you can see here that the VGT mix ended with $639,000. And I notice I have these in order, which works out nicely. So here in second place, the QQQ mix was at $595,000, not too bad. And then the SCHG mix came in at $556,000 as an ending value. And again, this is just under 14 years of DCAing $1,000 in and starting with the 10,000. Not terribly unrealistic. And VU here, the benchmark, came in last place at $534,000. We'll get into this return information down below. You can see the standard deviation. It's always interesting, and yes, it's still the case. The SCHG mix actually comes with a lower standard deviation than VU, which I always find kind of weird because it outperforms it in good and bad markets. It has a better best year, a better worst year, and a lower standard deviation. It is really quite the mix. But you can see here that the Sharpe, the Sortinos, these ratios, the benchmark correlation, everything's going to be about the same because they are very similar mixes. And that's reflected here in the portfolio growth. You can see that all of these portfolios go up and down together. You're never going to have picked the right crazy asset moment of springing way up when one's down or vice versa. These bad boys really do move together, which is good when you want to consistently outperform something. And down here to the annual returns, this is interesting. You can see that the teal one here is the market, and it's on the far right of each cluster. Now, first of all, everything runs pretty much together, as I've already pointed out a few times. And you can see the market actually won back in 2012, the first year of doing this, and it also won last year, and it's ahead this year. So you will get runs. It's much akin to VT versus VTI, like the whole world market. Every once in a while, it'll reel off like 2, 3, or 4 in a row. But when you zoom way out, VTI runs laps around it. Now, these guys don't run laps around VU, but don't think that these mixes win every year. We did have a streak of 10 years in a row of my specific mix, the blue one here, outperforming the market, which I made some videos about. And of course, because I made those videos, the very next year it made me look stupid and fell a little short here. So don't get too high and don't get too low, because investing is a long game. One thing I wanted to point out though, look at these down years. Market down the most, market down the most. Now, that is doing what SCHD does. And I love to see that stabilization when growth is falling, because remember, when growth falls, VU has a big chunk of growth, but it was only down 18%. VGT and friends were down 30%. That in 2022, for example. SCHD still balanced them out to outperform. That's where you want to be. You don't care if you're way up here, because it takes 1 or 2 tragic years if you're YOLOing into crazy assets to have everything come crumbling down. You want to focus on these down years. And the last one I think we'll touch on here is just the trailing returns, and we'll get quick here because this is probably gonna be an hour video. But the full returns, again, they're very ballpark close, and it looks like they're in order here. So the VGT mix is at 16.7%. QQQ is at 16.2 on the full 14 years. SCHG is at 15.2. And the market is at an incredible 14.7 annualized return. We would take that all day, every day. Historically, this averages out to about 10%, just over the last century plus. And then for the 10 years, similar story here. 16.7 for the VGT mix, 15.3 for the Qs, 14.4 for SCHG, and 13.6, still very impressive for VU. You can see VU actually outperformed the SCHG mix and the QQQ mix over the last 5 years. Very interesting. Still falls short of VGT. And then VU, as we saw above, has been the king on 3 and 1 year. So I don't know. You just never know with this stuff. So I'm of the mindset to stretch it out as far as possible to see what happens over long periods of time. But I do think it's interesting to look at all the data. The results are clear. All 3 simple 2-fund portfolios have managed to outperform the S&P 500 for well over a decade. I've leaned on the VGT SCHD combo in my own portfolio, and it's given me steady outperformance. Those little percentage wins compound into something powerful over time. You're welcome to try one of these mixes or to tweak it and make it your own, but don't get too creative or carried away. Because remember, well over 90% of investors fall short of the market's returns. Simplicity usually wins out. And speaking of huge overperformers, a huge shout out to a returning channel member, Anurada, and to a brand new channel member, Vermani. I really appreciate the support, you two, and from everyone that's been here all along. I really do appreciate each and every one of you for making this possible. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.